Kulkarni is a finance professional with over 23 years of experience in corporate finance, accounting, M&A, IPOs, financial recruiting, and digital banking. With 9+ years in startup, he specialized in finance, compliance, MIS, and business strategy. He has played key roles in balance sheet recruiting, ERP implementation, working capital optimization, and international corporate finance across North America and Middle East. As a director, mentor, and visiting faculty, he actively contributed to finance, education, e-commerce, and startup growth. A certified public accountant, CPA USA, and chartered accountant, ICAI India. Prasad is passionate about business innovation, automation, and process improvement, helping organizations drive financial efficiency and strategic expansion. Over to you, sir, to address the topic.
Thank you, Sajid sir.
Okay, sir.
Really appreciate your kind introduction. So
Welcome,
very
sir.
quickly, let me start sharing my screen. Today we are going to discuss on capital markets. So again, let me just focus more on the practical aspects, the Excel maybe, or what do you say, some insights into the real financial markets. I mean, we'll see some graphs. Um, PPT, I'm just using it as an anchor. And as we move forward, I mean, just quickly we'll cover PPT in 5-10 minutes, maybe 15 minutes. And then I'll jump into the valuation part, the present value part, which is most important as far as stock markets are concerned. And the NPV method, the CAPM method. And then I'll show some graphs as to what is actually happening in the markets today when we look at Nifty. One of the important topics today that we are going to discuss is trend analysis. So, capital market analysis, stock market trends, portfolio risk return analysis, security valuation. These are the topics that we are going to cover today. Objective, structure and role of capital markets, how to track and interpret stock market trends, risk return trade-off in the portfolio management, get introduced to basic techniques of security valuation. Uh, Again, I think most of this is pretty commonsensical. I mean, since most of us are from finance background, I need not introduce what a capital market is. I mean, the classification of markets generally is into primary and secondary markets. The primary market relates to the IPOs and the FPOs. FPOs are follow-on public offers, I mean, generally, but IPOs are predominantly what comprises of the primary market. The first time when a company uh, brings its shares into the market to sell it uh, to the public at large, that is called as a IPO, and that is typically a primary market. Secondary market, once the shares, and in IPO, that is the only time when a company actually deals directly with the shareholders, typically. After that, I mean, in the secondary market, there is no interaction or there is no company involvement as far as share markets, as far as the trading is concerned. So, people trade share equities amongst themselves. So the company does not get involved into the secondary market per se, except during a buyback of equity shares. Otherwise, the company stays away. So primary market IPOs, FPOs, secondary market NSE. I mean, we know there are stock exchanges, National Stock Exchange, Bombay Stock Exchange, MCX. There were other stock exchanges also, but I think most of those stock exchanges are now almost non-existent. Calcutta Stock Exchange was one of the most actively traded stock exchanges at some point of time. But I think today NSE, BSE cover most of it. MCX is now MCX deals with the commodity markets, so all gold, silver, etc. As we speak today, I think there is so much of turmoil that is going in the markets. Nobody is able to judge what direction the market is going into. Gold is peaked at its lifetime highs. Silver too. I mean, gold and silver now are like silver is almost 100,000 rupees, 1 lakh rupees, and gold also inching towards that 90,000 or so. Uh, just a couple of years ago, if you see where gold and silver were, we can understand what is the importance and how much value you can make just by analyzing a few simple things into the market. And it is an incredible journey also when you deal into when you get into the stock markets. There are several types of participants in the stock market, retail. I mean, when I say stock market, I'm talking about stock market, the commodities market, the mutual funds, the bullion market, forex market, everything. So when I'm saying stock market, I think most of the principles would more or less apply to all these markets. The participants are retail and institutional investors. Institutional investors like foreign institutional investors and domestic institutional investors. There are two types of institutions. So if you see the Indian stock market since post Diwali, if I remember correctly, I think 2nd or 3rd of October or November after Diwali, the first second day, the market has been in a downward spin. And the one of the most one of the reasons that has been told why the market is going down is that the FIs are booking profits and FIs are taking out money. So I mean, several lakh crores worth of stocks have been sold in last 4 or 5, 6 months. Again, now that the buying has come in, there is some. I mean, there is still some jittery in the market. I mean, people are not aware about what next. I mean, with whatever is happening with respect to tariffs in the United States, equal tariff for several countries. So everybody are just on a wait and watch mode as to what the outcome would be on tariff front. But right now the market is looking at some bounce back, some profit booking or some value buying is happening right now in the market. We'll talk about I mean, we'll see how the charts charts show us those trends. So the mutual funds are active buyers into equity markets, foreign institutional investors, brokers, regulators. Retail are people like you and me who are small individuals who are investing into the stock market. So that's what retails are. Capital markets drive economic growth and wealth creation. So wealth creation per se, when we look at wealth creation, there has the amount of wealth creation, that the value of wealth creation that is happening in the stock market is unbeatable. I mean, I mean, as Warren Buffett has, I mean, just to give you an example, Warren Buffett bought Coca-Cola. I think Coca-Cola was one of the stocks that he had bought when the market was down, and there was absolutely it was pretty gloomy market. But that's when Warren Buffett actually entered into Coca-Cola stock. He made some multi-million dollar investment in Coca-Cola. Today, the amount of dividend that he's earning out of Coca-Cola investments is significantly more than what he had already invested. So the dividend itself are more valuable than the value of investment itself. Again, Infosys was another great story. I think one of the early companies who got into the stock market, who got into the primary market first with an IPO in 1991, 92, 93, I guess, after the deregulation of by the PV Narasimha Rao government. Inscription. I mean, otherwise it could have been a failed IPO, but they just scraped through that IPO. But today, when we look back, I mean, that 10,000 rupees of investments in Infosys today, maybe 30 years later, would be worth anywhere in the range of 2, 3, 4 crores. I don't know exact value, but it would be in excess of that. So the enormous value creation that happens through the stock market is unbeatable, and that's why many people are getting into the stock market. But again, there are flip sides also. There are some pitfalls also in the stock markets, or in capital markets, to so to say. I mean, patience is the key, and understanding the trends, understanding the fundamentals, understanding the technicals. I mean, we have to be aware about all the news flows that are happening across the globe. Today, we are not isolated per se. I mean, even in India, we are so much dependent. I mean, some news coming out of the US, some news coming out of Europe, some news coming out of some place, somewhere, sectoral analysis. There are regional analysis, there are product analysis. I mean, all these news will have a significant impact. Global economic factors will play a very vital role in the domestic markets also. So the key indicators, when we look at the markets, the key indicators are Nifty and Sensex. We'll talk about Nifty. Nifty again is a very prominently traded future. Sensex, sectoral indices, when we talk about auto indices, pharma indices, ancillary auto ancillaries, FMCGs. So these are all indices. So there are a group bundles of Bank Nifty, for example, Fin Nifty, for example. So these are bundles of stocks um, which are uh, which are traded on the stock markets in futures and options market, FNOs. Okay, derivative markets. We call that as a derivative. So capital market, primary, secondary is one classification. The other classification would be equity markets, derivatives markets. Then there could be mutual funds. All these are also the types of capital markets, or the party or the various components of the capital market. FIS, DIS flows we talked about, macro factors, the GDP numbers. I mean, the GDP, I mean, every month, I mean, just to give you an example, every month the auto industry have to declare their monthly numbers as to how many units were sold and stuff like that. I mean, if you look at that monthly closing of auto indices, you will get an insight about, based on those numbers, based on the pricing. So recently, Maruti Suzuki have hiked the prices of Maruti Suzuki share, Maruti Suzuki companies. What is the impact of those onto the shares of Maruti? Recently, I think Force Motors got a big order from the defense. Now, what is the impact of that big order on the shares or equity? So those news also will have a very significant importance play into the market. Inflation rate. When we talk about inflation, I mean the value of money per se, whether it is increasing or decreasing, the number of commodities or units that I'm able to purchase from the same value or same number of units of rupees, is it increasing or decreasing? If it is increasing, then there is inflation. If it is decreasing, then there is deflation. The inflation number just in domestic markets may not be of significant impact. It is, I mean, the global inflation, the general rise in prices of commodities is inflation. Interest rates play a very significant. So every quarter, I mean, the RBI in India comes out with the monetary policy, the interest policy, and small changes in repo rates, reverse repo rates will have a significant impact. I mean, interest rates play a very vital role because the availability of money in the market is managed by the interest rates by RBI. So banks are allowed to circulate that money in the market subject to the repo rates, repo or reverse repo or CRR and all those rates. So if the interest rates are hiked, then the supply of money would be decreased and vice versa. We'll talk about some technical patterns, support, resistance, moving averages, RSI, MACD. These are like technical words, moving average, convergences and divergences, relative strength index of the market and stuff like that. Portfolio valuation, I think I'll prefer to do this in Excel rather than just on PPT, but we are talking about the sensitivity of the market to the sensitivity of the share to the changes in the market. So if what do we say, higher returns, higher the risk, higher the returns, and vice versa. Lower the risk, lower the return. That's why FD is considered to be a safe haven. Okay, when if somebody does not want to take a high risk, but when it comes to commodities, equity markets, derivatives, etc., that is higher, very high risk. But when we say high risk, high return, when we say return, the return word is looked at or it's taken at in a positive way. That means there would be only, if I take higher risk, I will get higher gains. But that's not the case. Higher risk means higher the risk, the higher the returns. It could be a positive return or a negative return. So that thing that most of the people actually, when they venture into the market, they forget about it. Tools, standard deviation, that is the volatility of the market to the. So if a market is increasing by 1%, how is my stock reacting to that volatility? So how fast? So standard deviation beta also is also a market sensitivity. How sensitive is my stock to the changes in the market? We'll talk about beta. So if my market, for example, if Nifty rises by 2% and I am say holding Infosys as a stock, if Infosys has a beta of 1, that means my stock is pretty stable. So it does not move with respect to the market. Okay. But if I have a beta stock which is of 1.5 or 1.8 or 2, then for every 1% increase in the market, there is a chance that my stock will increase by 2% or negative 2%. So that is +2 or -2. That is beta. So market sensitivity. This is used mostly in CAPM. So capital asset pricing model, we'll talk about it. Sharpe ratio, again, risk adjusted return, something similar to CAPM, but again, this is we'll just glance through it. Diversification is the key to success in market. Okay, don't put all your eggs in the same basket. I mean, it's one of the most important lessons that I have learned personally from the market is never or ever bet on one stock, never marry a stock. Okay, keep it as an investment and just make sure that you diversify your risk as much as possible. Put money in fixed deposits, put or debt instruments or mutual funds and equities, gold, real estate market. Again, you have to have a very good ratio of your portfolio into this different baskets. CAPM, one of the foundational models in finance for estimating expected return of a stock portfolio. This is a simple return. The expected return is equal to risk-free return plus beta, that is the market sensitivity into the risk market premium. So just to give you an example, if I have to invest in a stock market, for example, what would be the first thought that should come to me? I should earn at least or equal to the investments that I have already made. For example, fixed deposits. So say if fixed deposits are giving me 10% and I have to invest in stock market, my expectation should be I should at least get 1% more because I'm taking risk over there, or 2% more or 3% more. That RM, so 10% is the risk-free rate that I'm earning right now, and RF is the expected rate, okay, or the market risk premium as it is called. That should be over and above your base rate. Okay, so because I'm taking higher risk, so CAPM, the premise of CAPM model is you are taking a higher risk, and because of that higher risk, you show your expectations from that market should also be high. So that is the significance of market risk premium. So simple. So this can be used for a particular stock also, or could be a entire portfolio of stock. Okay, so you can calculate the beta for each stock. So we'll look at, so betas are available on websites like Money Control or Trading View or investing.com, several websites. So we'll look at Trading View or maybe even Money Control also. So this model is terrific. It is used for comparing stocks. So price securities, I mean, for pricing the securities and evaluating the risk return. So if my expected rate, I mean, depending on different instruments, I will choose a instrument which has a highest expected rate. Simple as that. I mean, we'll look at some examples in Excel also. There are certain valuation basics. So we'll look at two different. So if a stock is traded, then the share price of that stock is nothing but the price of that share. Okay, so valuation is one of the most important aspects. So we have to identify which are the undervalued stocks and which are the overpriced stocks. So when we want to bet or when we want to get into equity market or any market for that matter, we have to find value. Okay, so there is a terrific book and a terrific author, Ashwath Damodaran. He has written a terrific, wonderful book on valuation. I think one of the milestone books when it comes to the topic of valuation. So if you guys get a chance, I mean, grab that book if possible. But that is a fundamental book on valuation as to how do you price a company. So there are different models, price to earning ratio. So how much what is the stock market price divided by the earnings per share? Okay, so how many times is the price of that share? So higher the PE ratio, that means overvalued. Okay, the price is too high. Similarly, price to book value. So if a company does not have shares which are listed on stock market, then derivation of that price becomes a challenge. But then so that's where we use discounted cash flow method to calculate the intrinsic value of that share. Okay, that equity price to book value. Dividend yield also. There Gordon's model is there, which is taught mostly in colleges. I mean, the dividend plus growth model, Gordon's model. So there are those models which are used. But typically, across the board, all organizations use the discounted cash flow method or the NPV method, net present value method. Discounted cash flow method is the benchmark for all valuation studies. I'll show you one valuation that we have done. Very simple valuation. I mean, valuation process start from your balance sheet, your income statement, then your cash flow, and then you start with looking at the valuation. So cash flow is your primary input for your valuation. We'll talk about technical patterns, head and shoulder, double top triangles, etc., flag panels. I'll share this file, this worksheet. So let me just directly get into first. Let us get into trend analysis. Okay, let us get into trend analysis. So let me just Are you able to see this trading view screen, or are you able to see this screen, trading view? Let me just share it again.
Yes, sir.
Okay. So this is a simple, what do you call, Nifty chart. Okay, this is a Nifty chart that I'm showing to you. Now this is, say, let us keep this as a 5-month chart. So every candle, I mean, we are looking at trend analysis. Okay, we are looking at trend analysis. So typically, once you look at this chart, I mean, since 1991, if you look at Nifty from 328 rupees, okay, 328, in fact, 279 rupees was the beginning point. Okay, if you see over here, okay, okay, 279 was the opening value of Nifty when it started in 1991, 1990 February, Friday, June 1st, 1990. And what is the value today? Okay, if you look at this trend, you will see, I mean, when you start looking at the market, I mean, fundamentals are absolutely irrelevant. You cannot deny the fundamentals, but a visual inspection of the stock market or visual inspection of any graph, you can say a candlestick graph or whichever graph that you want. uh, there are different types of graphs. So let's look at a line graph, for example. A line graph also would be extremely relevant over here. Okay, it will give you a very good insight as to how is this market behaving. I mean, yes, it has continuously gone up, came down. It has continuously gone up, came down, gone up, came down, gone up, came down. So market always works in waves. So identifying and understanding those waves is very important when it comes to getting into the capital market. Our capital market, when we talk about, I mean, again, uh, uh, you talk about mutual, I mean, all graphs are available. If you want to get into cryptocurrencies, you will have those graphs. If you want to look at mutual funds, you will have those graphs. So looking at the graph would be the first thing that you need to do, and looking at how is this, what is the long term trend of Nifty. The long term trend seems to be pretty neat, pretty, it is going up. Okay, so if you see, the market has gone up from here to here, which is massive. Okay, from 400 or 300 rupees to 24,000. You can imagine what the returns are. Okay, let us look at this candlestick chart again. These candles represent the Nifty movements over several years. So if you see these big red lines, this was 1st June 20. This was the Corona line. Okay, this was the Corona line. If you remember what happened during the 2020 pandemic, market went down. But there is a very important thing that needs to be observed in this market. In fact, many people made a lot of money during this time. Uh, Again, I'm not here to teach you how to make money, but understanding the charts and understanding the graphs is very important. If you look at this trend line, this single candle, you see there is a long shadow to this candle. Although it went down, okay, there was indecisiveness below these numbers. This is again kind of a hammer or a doji kind of. The long shadow represents there is no support for the market below a particular level. So 7,900 or whatever that number was. After that, immediately in the month of, after 6 months, so we are looking at a 5-month graph. Let's look at monthly graphs and do a little bit of analysis. Okay. This was that number. So if you see 1, 2, 3 months, but after that, the market has gone significantly up. So people who understand this, so in stock market or in equity or capital market, there is one fundamental theory that you should be aware of, is the Dow theory. Dow theory is, I think, if you don't know, if you do not need to know anything else. You don't need to know anything else if you know Dow theory. Dow theory is the market will keep making higher highs, higher highs, higher highs, higher highs. Similarly, at the same time, it will also make higher lows, higher lows, higher lows, higher lows, and vice versa. Lower highs, lower highs, lower highs, lower highs, lower low, lower low, lower low, lower low. So if you see over here, okay, here was a significant, uh, what do you say, support over here, this line. Okay, the market did not go below this significant low. Okay, it tried to reach there, but it just bounced back from there. and then it has become, this is a higher high, this was a high, this was a high. See, if you see all highs, okay, this is a high, okay, then again this is a high, then this is a high, then this is a high, then this is a high, sorry, right? If you see, the market has been making significant subsequent consistent highs also. Now similarly, on the lower side, the market has been making higher lows. Okay, let us change the color for this. This was that low. After this low, it made a higher low. After that, again it made a higher low, again a higher low, again a higher low, and now it is in that trend right now. So all these red lines and green lines, if you see now, I know that the market is in the range bound now. So how do I understand the trend line? So how do I anticipate what is the price of a share? I mean, it is using a CAPM model, you can find out what are the expected returns. But there is a drunken man theory which says you cannot never ever predict the price of the share. Okay, but when you are looking at technical analysis, and if you are backing that technical analysis with some fundamental aspects of the market, you will be able to predict the share price also. And let me just give you one example very quickly. I keep trading in crude oil, and I keep tracking crude oil very regularly. uh, I mean, almost on a daily basis, I keep tracking crude oil and natural gas. These are the two stocks or two commodities that I trade in. Just to give you an example, can I predict the stock market now? If you, I mean, there are so many lines over here. Forget about those lines. The today's crude oil has gone down significantly. It went up significantly. These are like the daily candles. Now, this candle, okay. Now, if you look at this green candle over here, let me draw a vertical line over here. This green candle was a significant candle, okay. And if you see, there is a cross section over here. Now what are these cross sections? Let me just give you one more insight. Let me just delete all these drawings. Now this greens are nothing but my resistance, and the reds are nothing but my support level. So if the market has gone up to this level, okay, the chances are after this top it will come down. Maybe this could be my next resistance level, or the support level rather. So I will expect that the market might come over here, okay, and it may again, nobody can say definitely whether that will stay over there or it will go up or go down. Again, we have to just follow this trend. If the trend is your friend, if you understand how to follow the trend, then there is a good mechanism to find out what would be the typical prices. Now coming back, so now if I have to find out the trend, let me just delete this. Now let me draw some trends over here. um, So I'm using TradingView. So I have a paid subscription for TradingView, which is one of the most important tools that has got a lot of analysis that you can do in the chart, on the charts. So let us do a very quick analysis. This is a monthly chart. Okay. In the monthly chart, let me just this was a significant high. Let me just connect these two highs. Okay. So this becomes my resistance. Okay, the market has gone down, is gone up. So my top level, this is like my ceiling. Okay, just a sec. Okay, so this is my ceiling, and this was a significant drop, significant bottom. Now, which points to pick up? You have to just pick up the all the tops and all the bottoms. Try to find a line of best fit. Okay, which will fit most of the points on the graph. Now let us look at this. Let me connect this point with maybe this point. This was a significant down over here, or maybe this down. Let's say this down. Okay. So this is like, now it is a narrow path which is happening right now. It has gone, it is like, it's called as an ascending triangle or ascending triangle. So it's going up. Okay. The trend is upward only. If you see, the trend is upward only. But the market was moving within that trend, or within that triangle. Now the triangle, it came out of that triangle. Nifty has come out of that triangle on a monthly chart. Okay, if you look now, let us go to a lower time frame. You have, when you look at trend analysis, you have to start from a higher time frame and then start drilling down into the lower time frame, because trends are long term in nature. The trend reversals can be in the short term. Okay, trend reversals will happen in the short term, but trends are, if you can see the trends in the long term only. So let's look at a daily chart now. Now here I have this daily chart. Now I can see this daily chart, what is happening on the daily chart. Again, I can draw some trend lines over here also on daily charts also. So now I see this line that I have drawn earlier. Can I shift it a little bit? Okay, instead of here, can I put it over here? So here now I am able to cover 0.1, 2, and almost 3. So now, if you see over here, this small fraction over here, now I can see some patterns over here. Okay, uh, inverted head and shoulder, for example, it is being formed right now. Okay, let us talk about head and shoulders also. But I mean, a head and shoulder, where to find? This is again not. So it could come over here. So once it breaches this line, it will go up again. Where to find these trends, or where to find these patterns? You should find, if those patterns are happening at your trend lines or support lines, long term trend lines more specifically, then you would be able to, those are more reliable. Nobody can say, if somebody tells you that 100% conviction that this stock will go from 100 to 200 rupees, say you are Bhagwan and just get away from that. There is nobody in the world who can actually exactly predict what the stock prices are. But you can anticipate, you can estimate. There is a high probability that the market will go to that level. Now, if you see over here, now, I mean, the initial my discussion was, I mean, how do I predict prices? I mean, there are multiple ways to predict prices. Now, here is this price range. Okay, now, since the moment I see that this point is being breached, this point will get breached. Okay, okay, this point over here, if the price breaches this point, then I can safely assume that from that point I will have, my market will go up to 25,825 or something. But I will not wait for 25,000. I'll put a stop loss, or I will try to take 10% cut over there and find out what's a 25,670 or 25,500. Okay, the market will start reversing from that top level the moment it reaches. If you see, every time the market has hit this line or tried to reach this line, okay, it will start reversing. It went over here, it bounced back. It went over here, it bounced back. It went over here. Now here we are at the cusp. So the number of times it is bouncing back from the support or a resistance, the higher the probability that you will be able to anticipate the prices more with a high probability. Now, head and shoulder, I mean, this is the inverted head and shoulder, may not be the right example, but I just was showing you as an example. So a pattern has to be seen at the support and the resistance. So if you see a head and shoulder over here, inverted head and shoulder over here, that means that is a good bullish sign, and it is appearing at a support level. Support, this is the support line, then there is a high probability. I will not say with with conviction that this will go to that level, but there is a high conviction that the prices may go to a higher level. But again, there are so many moving parts in when you look at the markets. The moving parts are news flows. The news flows are so enormous today that some news today, I mean, if you look at crude oil today itself, this is a massive fall from 6,134 rupees to 5,600, and it is still falling. Now again, I was giving you this example of crude oil. I was looking at crude oil. I had drawn this, what do you call, support resistance. There are multiple resistance, supports and resistance that I have drawn. Okay, for our relevance right now, my best thing that happened was this line. So let me just color this line a bit. I'll make this line bolder and this line also bolder. Okay, if you see this, there is an intersection of the long-term trends. The long-term trends are intersecting, and the support and the resistance are intersecting. Now, what is happening over here? This red candle was formed. I was not trading over here, right, at all. This was my resistance. I knew this market crude oil will come down, but I was not willing to put my money into the market until I saw a clear trend. Okay, clear trend. And then this candle happened. If you see this candle, this is like a massive candle. Oops, sorry. This is a massive candle. And it is, again, we call it as a father candle, mother candle, whatever. It's a big candle. Now, if you see the subsequent candles, now this candle is taking rest on this red line. Can you see this candle taking rest on this red line? And my entry was over here. My entry was over here because this red candle, it is still not. This red candle bottom is over here. The trend is now sideways. Okay. And I was waiting for a right opportunity. And then this candle actually happened. And this 1, 2, 3 candles actually happened. Now the trend was, there was some reversals that was happening. This was like a lower low. This was a higher low. Again, this was a higher low, higher low, higher low, higher low. And then this was the market. This candle actually broke out of the mother candle. So how many candles? So if you see a mother candle, a very big mother candle, now this also is going to be a big mother candle. I'm waiting for this. Now, if you see where is it resting right now, the market, today's day is not over. It will get over at 11:50, 45 tonight for commodity market. So we still don't know what the status of this candle would be by end of the day. But right now it is like a massive drop on the. So this, if it breaks over here, okay, if it breaks this green candle, green line and this red line, then I am sure that it will fall even further. Now, where can it fall? Now, I have a trend line over here. The first step. Now, how do I anticipate the market price on technical analysis? Now, I would be able to see that here it will come down to, maybe if it goes below 5, 6, 7, 8, it may go all the way up to 5, 5, 7, 9. Okay, there is a intermediate hurdle over here, but again, that is not a very significant hurdle. It may bounce back from here, but this is my anticipated market. If it bounce back from here, where do I see? Again, it will go to this level. It will go to this level, this level, this level. So I have those 3 levels. And as they say, I mean, the charts don't lie. Okay, charts don't lie. And you have to keep doing the back testing of these charts frequently. If you see this green channel, okay, how many times the market went up, came down till at this level, went up, came down again, went up, came down, went up, came down. In a span of 1 or 1.5 months, this is happening. Now, if you go back into history also, you will see the same thing. Okay, markets will keep repeating history. So if you see this 1, 2, 3, 4, 5, and now there is, if you see the long-term trend, now this is a nice triangle that has got created. Okay, now there is a fantastic range-bound market. Now you have to see what will happen next. But these are you can play momentum trading, you can play whatever. I mean, what do you call other momentum? And there is one more term I forgot. So you can range bound trading. So you can keep doing intraday also and stuff like that. But understand, if we doing intraday, long term, short term, 5 minutes, 10 minutes, 15 minutes, again, it's, you have to look at the long term trend first before you actually get into the market. Do not ever, never, never, ever, ever. I mean, whosoever it may be, you have to do a back testing yourself before you actually enter into the market. Okay, so that is how to identify trends, how to identify trends in the market. That's trend analysis for you. Now let's look at, again, these are again crude oils only. Let us look at some other chart. Any chart you guys want to suggest that you want to look at? Any chart that you guys want to suggest that you want to look at?
Participants, you can inform.
Yeah. So let us look at Infosys only, because one of the key companies in the IT sector in India, it is also an index in itself. I mean, if Infosys is going up, the entire sector will follow Infosys, and vice versa. If Infosys comes with a very negative, some bad news, the entire sector will come down. So that's how Infosys is like a benchmark stock, for example. Okay. Now, if you we were talking about, there are two. You have to look at, again, these charts alone are not enough. Charts alone are not enough. You have to see that. I mean, I mentioned about the MACD and the RSI. RSI will come to it. generally, in or in any market for that matter, commodities, bullion, whatever market, there are these short-term trends, medium-term trends, and long-term. So we call it as days moving average. So 5-day moving average, 20-day moving average, 100-day moving average, 200-day moving average. Now these moving averages play a very vital role. So I mean, let us go back to our school days. I mean, our percentages, we were scoring, we were appearing for 6 or 7 subjects, and the benchmark was one number called percentage. I have got 80%, I have got 90%, I have got 60%. That 60% was a representative of all the 6 subjects taken together. It was the, let's call it as it was an average of all the subjects. Okay, in the stock market, since it is a very dynamic number, every day the numbers keep changing. We have to look at the moving average or the trailing 10 days or the trailing 20 days. So if I am today, if I have to look at the market, so I will look at 5 trailing days starting today. Tomorrow, when I look at the market, I will start from tomorrow. And one day from the beginning it is also the way we do rolling forecast, exactly the same way. So we ignore 1 month from the rolling forecast, the beginning month, and we add the ending month. So similarly, the moving averages play a very vital role. The intersection of your short-term moving averages and long-term moving averages are the places where there are significant trend identification that will happen. Okay, now if you see over here, this chart itself, there are 3 moving averages that are over here on the chart. Let us look at those 3. So this is a 5 exponential moving average, 5-day exponential moving average, 13-day exponential moving average, 26-day exponential moving average. How to identify prices is one aspect of stock market which will come with a lot of expertise, lot of analysis and stuff. But can I at least identify where I can make an entry or make an exit from the market? Then this would be a game changer for most of the people who are into capital markets. Let us look at every time. Let me just expand this. Just look at over here. Okay. Just look over here. There is a significant reversal over here. There is a significant reversal over here. The 5-day moving average is at the bottom right now. But over here, it was at the top from this blue line. The blue line is the 5-day, the short-term moving average. The short-term moving average moved from, it moved just down over here. It crossed the medium-term moving average and also the long-term moving average. That means in the short term, there is a significant trend reversal. The market was going up. Now the trend has reversed and it will go down. And immediately after this crossovers, we call it as a crossover. Is my voice audible? I mean, there is a lot of rain right now in Pune. So there it's banging on the doors. Am I audible properly?
Yes, sir. Yes, sir. You are audible.
All right, sir. Thank you so much. So this trend reversals are these points. Okay, if you see over here also, when the blue line is crossing the yellow line and the red line, green line, you see a change in the market. Okay, and just keep moving moving across. Okay, over here again trend reversal, again here trend reversal, again here trend reversal. So identifying where I may be able to make an entry or make an exit from the market, or to even suggest that, I think that this would be a very fundamental analysis. A 5-day moving average. Now people I use 5-day, 13-day and 26 day moving average. Some people use 10-day, 20-day, 30-day, 50-day, whatever. So you have to find your ethos about how do you want to do the evaluation. Now talking about RSI, okay, let us look at the RSI. This is the RSI graph, relative strength index. The relative strength index identifies whether there is momentum in the market. I mean, there is a fight that is going on in the market. The buyers are trying to take the price up. The sellers are trying to pull down the prices, or sorry, vice versa. The sellers are trying to pull up the prices and the buyers are trying to pull down the prices. So whichever is beneficial. So there is this tug of war that is happening in the market. Now that tug of war actually leads into a significant price impact. and the volume impact. Now, when these volumes and prices are impacting the stock markets, RSI, relative strength index, how much is the strength in that price? Is the is the strength justifying the price move or not? Now, if you see, there are these two ranges that are happening. So this is the no trade zone. I mean, no trade zone. I mean, from for depending on the everybody's what do you say, mm, uh, mechanism, trading mechanism or trading personality. You have to decide what. So typically 80% is a range. Above 80%, they say the market is oversold. If you see over here, this place. So this, if you see this point over here, this is a oversold zone. That means, sorry, over purchase zone, overbought sold. Now the price will not sustain above that level, so it will certainly fall down, and that's what we look at over. If you see, let us try to put a vertical line over here, okay, and see what is actually, this is the RSI. Let us see what is the change in the price, okay. If you see this vertical line, okay, the market has started falling down from there. Okay, the market has significantly gone down from there. If you see over there from this vertical line, the market is in a downturn. Now, if you look at again, look at that same graph, not DMI, RSI. The same graph, if RSI over here, you see now there are this multiple bulls now getting active. Okay, the prices will start. This is like a super oversold market. Super oversold. Matlab anybody who will get into, I mean, they will get into that market at that point of time. They are going to get some good returns. That is, again, can I convincingly say that this is the bottom? No, I will not be able to say that. But this is an identification of some trend reversal, that in case of overbought and oversold market, there is a bounce back again that will give you some good return. So if you look at this vertical line now, okay, let us see what is happening in the, see, there is a bounce back. So from here, the market was oversold, there is a some bounce back. Now from here again, we can see that there is a trend reversal. Okay. So again, there is, the market went up, and again it has started falling out. So this is how you have to identify trends. Identification of trends should always start from your long-term views, build a long-term view, then from long-term view, come to the medium-term view, and from medium-term view, come to the short-term view. Now we have been talking about the FIIs taking away money. Let us look at Nifty again. Okay. Nifty on a monthly chart. Okay, let us delete all this. If you see, this was 1st of October. This month, 2nd or 3rd of October, FII started selling, and since 1, 2, 3, 4, 5 months, they have sold it continuously. They have sold the stocks every month. They have been selling. Okay. Now, if you see, let me just give you, this is like a nice two green and red. Now there is a bounce back from over here. There is a bounce back from over here. There are some green shoots now after repeated pounding. Now there is, in this month, in the month of March, the market closed in a positive territory. Okay. And it has made, now if you see, these two are very identical. There is a very significant pattern that happens over here. This is a pattern now. That means there is a good chance of some recovery. But again, that recovery is still not convincing at the moment. It may be or it may not be. We have to look at the next layers. But if you identify all this, for example, this, let me put it over here. This was a significant low, a recent significant low. Okay. A recent significant low. This was in the month of June 2024. Now, despite a lot of what we saw, say, chaos in the market, did the price come down to this levels, which was the recent lows? It has still not reached. Okay, so it has actually bounced back. It is almost on the verge of bouncing back. Let us thoda sa do a deep dive onto a daily chart. Okay, let me delete this. Okay, if you do a daily chart, in daily chart or in weekly charts, you will see the intermediate trends. How these waves, now these are all waves, one wave, two wave, three wave. Now this was the top. Okay, this was the top. Okay, this was the uh, one of the first lows in the market. After that, it went up. This was the top. This was a low. Again, this was a lower high. Now, if you see over here, it tried to breach that, tried to make a higher high. So this was a high, lower high, lower high. This is still a lower high. The moment I am able to see a trend reversal, the moment the market makes or breaches this 23,803, I would be able to say that the trend is reversing, and I will start looking for an intermediate level of, say, close to this level. Okay, so this is the way in which you draw a support and a resistance line, identify what is. So again, try to, when we say this is a support line, I mean this is a resistance line. Let me convert it into red. This is a resistance. This is a resistance. Okay. Now, this also is a resistance. Now imagine you want to break through the ceiling of a building. In one punch, you will not, unless you are a Superman, but otherwise, in one punch, you will not be able to break that ceiling. So you will have to keep pounding that ceiling multiple times. So similarly, the support and resistance act in the same way. If it reaches over there, it may not be possible for it to breach that first time. So you have to look at the history. Has it breached that level? Now here, if you see, there is a very nice head and shoulder. Let us just draw that. Okay. Okay. Oh, sorry. This is, let me draw. If you see over here, this is like a head. So here, if you see what is the price that I can anticipate over here, I got a head and shoulder at the resistance. That means it's a good signal that the bearish trend will start to kick in. So if this is the height, so this is the median which is touching the head and the two shoulders at the bottom and the head at the top. This could be a typical price that I can anticipate. Where is that here? Okay, here. So this would be a typical range that I can anticipate. So 70% of this, for example, this is how much this price range could be in the range of 27, 48 and 23. So 70% or 60% is what, if you achieve, that is good enough, right? So this is how you look at the charts. Now those charts, trend analysis. Now let's go back to the PPT for a moment. Let me just. Okay. So some key trends. Okay. So there are some head and shoulders. I think one of the most widely used pattern. Again, what is the success rate of head and shoulders? Maybe 60-70%, but 60-70% is still good enough for somebody to trade into the market. So if you are very conservative, if you keep yourself, if you're patient enough and you are understand the trends and you are a little bit conservative, don't aim for 100% in the head and shoulder. Aim for 70%, 60%. That should be good enough for you to give you a good return. A double top, double bottom. I mean, similarly in head and shoulder, you can see a double top and double bottom also. Let me show a double top, double bottom. Let me just finish this screen. Then there are triangles. We looked at the ascending triangle, the descending triangle, the symmetrical triangles. Now, the moment it breaks out of those triangles, your trends changes. That's where your price will start to increase, and where it will come and reach at the support and the resistance. It will try to break the support and resistance level. The previous highs and the previous lows act as your support and resistance. And you can draw trend lines. The angular trend lines are also very vital. Let us go back into the trading view. This angular trend lines, let me delete this. Okay. These angular trend lines are very, very vital. Okay. I mean, support levels, you can draw those absolutely horizontal lines, or the other way you can draw it is in this manner also. See, if this is tried to breach once, twice, thrice, it has broken out now. Now, after it has broken out, did you see that it has reached over here? The previous high. Okay. Here. Now, this is a fantastic signal that it keeps going down. Now, the market will come down over here. Maybe it will try to rest on this. Now, or I can draw one more line, which could be over here. For example, this would be my support line. Okay. This is like a triangle. But again, that's not significant right now. I will see where this will go down. Okay. Now, I can still go further down into an hourly trend and see what is happening. It is making a higher high, okay, lower low, or whatever. You can see this trends which are changing right now. So this is how you do a trend analysis. This is how you anticipate the stock prices. Now, one important topic was how to calculate or estimate what is the share price. Okay. Now, share price, one way we looked at was this thing, the trend analysis. Another 5-10 minutes we will be able to finish. Just give me some time. So in trend analysis, you are able to do that visually. But when it comes to fundamental analysis, when it comes to analyzing companies in a merger and acquisition, you have to use multiple models. The discounted cash flow approach is one of the most fundamental. You have to make a lot of assumptions in that to arrive at the cash flow. Now, what is the discounted cash flow model? Discounted cash flow, I mean, one important formula that we have learned in our 6th standard or 7th standard, that was called compounding, compound interest. Okay, compound interest, the reciprocal of your compound interest is nothing. In compound interest, you are going from present to future. Find out if 100 rupees invested today at 10% for 5 years will give me how much. So we are trying to go from present to future. The reverse of that is called as discounted. If I have to get 100 rupees after 5 years, what is the amount that I need to invest today at 10% for 5 years? Okay, so that is discounting. So the reversal of the compound interest, or the reciprocal of compound interest, is nothing but the discounted. This is the most widely and most reliable way to anticipate the stock prices. Now, here, for example, there are two methods that I have just showcased. One method is your book value. So we have looked at price to book value, and the other method is the net present value. So you have to find out which one is the best, depending on the circumstances. But typically, all the assets that I have less all the liabilities will give me my net assets. Net assets divided by my total number of shares. Okay, diluted shares, for example, will give me my share value. Okay, price per share. So assets minus liabilities will give me my net book value. Net book value, so that is the value that is available for all the shareholders, divided by number of shareholders, will give me my share price per share, or book value per share, price to book value. So this is a simple way. I mean, if you have the balance sheet, you will be able to calculate price to book value very quickly. Price to book value in the sense, this is you calculate the equity price. Okay. Then this is the discounted cash flow model. What we are doing over here. Now, these are the cash flows that I have anticipated. So I do a forecast. I do a simple forecast, a P&L, for example, a P&L over here. This will be for 5 years. I'll do a very simple sample P&L. I will try to find out what is my net income. From that net income, I will add back all the non-cash components. All the non-cash components will be added to arrive at something called as cash flow after taxes. I want only cash flows. When we do net present value or discounted cash flow technique, when we use, we have to look only at the cash flows. We don't have to take into consideration anything else. So all cash profits or cash flows after taxes are to be considered. Those cash flows are your inputs to your net present value model. In net present value model, now this present value factor, now we looked at the CAPM model, that is what is my premium, market premium. So if I am earning 10%, I should expect some premium. So I should at least say I need 15% or 20% or 30%, whatever. So that becomes your discounting factor. So how do I calculate that discounting factor? 1 divided by, 1 divided by 1.15 raised to 1, for example, to begin with. Okay. So this is nothing but the compound interest formula. Okay. Compound interest formula, just on the denominator, right? So in the second year, what happens is equal to 1 divided by 1.15. 15 is 100 plus interest rate, 1 plus I raised to n. Okay, 1 plus I raised to n. That is what we are doing. So raised to. So if you have to give raised to, there is a there is this key called caret. Okay, this caret is on the keypad. On the keypad on number 6, if you see that small hat-like structure, that up arrow key, that is a caret. It's the symbol is caret. So in second year, it will be 2. In third year, 3. In fourth year, 5. So on and so forth. Okay. So 1 divided by 1.15 raised to 3. Sorry. Raised to 3. 15. Sorry. And so on and so forth. So this will give me my discounting factor. Now, 100 rupees today, okay, 100 rupees today, is it equal to 100 rupees after a year? No, there would be some appreciation by way of interest rate. Okay, so 100 rupees today will be, maybe if it's at 15%, it will be 115 rupees after a year. So we are going to do compound interest in the future. So 115 rupees after a year at 15% will be equal to 100 rupees today. So that's how the calculation is. So 100 rupees, 1 rupee today is equal to 0.87 paisa after a year at 15%. Okay, or rather 1 rupee after a year is equal to 0.87 paisa today. 1 rupee after 2 years is equal to 0.76 paisa today. 1 rupee after 3 years is equal to 0.66 paisa today. So we are trying to arrive at an apple to apple comparison. What is the value of all the future cash flows going to happen at different points of time in the present? That's what the present cash flow or present value approach is going to do. So we just do the multiplication of this discounted cash flows. So cash flow into the present value factor will give you, so $496,000 or 4,96,000 rupees after a year is equal to 4,31,000 today. 6,64,000 after 2 years is equal to 5 lakhs today. 21 lakhs after 3 years is equal to 14 lakhs today. 28 lakhs after 4 years is equal to 16 lakhs today. 34 lakhs after 5 years is equal to 17 lakhs today. And there is something called as a terminal value. Now, when we do a business, the fundamental assumption of every business is the going concern concept, that every company, every entity continues to exist for a foreseeable future, unless otherwise it has any intention to close down or substantially reduce the scale of its operation. So in that scenario, we have to find out, just 5 years is not sufficient for us to calculate the present value. Then we have to calculate what would be the value of all those cash flows that are going to happen after 5th year. But that number may not be very significant, because the discounting factor will keep on, the decimals numbers will go on increasing. So even if the cash flow might be very high, because it is multiplied with a decimal, small decimal, the ultimate cash flow also is going to be very small number. But we have to calculate that till perpetuity. Okay, calculate this cash flow still all the years divided by number of shares. Now this company had 40 lakh shares, 40 or 4 lakh, 40 lakh shares, 40 lakh shares. So what is the value per share? 2020, 1220.95. So this is a simple way in which you can identify. Now, can we do this analysis ourselves? Yes, we can do that analysis ourselves. Look at the company's financial statements, draw this financial. So I'll show you one. I think that day also I had showed that model. Let me just very quickly, in 2 minutes, I'll show that. LinkedIn, for example. Uh, LinkedIn. So if you go to LinkedIn, so here is the valuation. So this is based on certain past data which we are trying to anticipate what will happen in the future. Okay, so this is actual for 3 years, and then we do the projections for next 4 5 years. Now, how do we unlock the potential of these companies? I mean, trend analysis is all about projecting or forecasting the numbers.
So
What
we are
are
not
the...
able to see your.
Oh, I'm sorry. Okay, I'm sorry. This is the screen. Are you able to see that screen now?
Now we are able to see, sir. The
Yes, yes.
previous we were not able to see, sir.
Sorry. So this is a valuation sheet for the LinkedIn and the Microsoft merger and acquisition that actually happened. So you can actually do the calculations, look at what was the past data. Based on that past data, you will be able to make certain assumptions as to what are the assumptions that you are going to make, how the revenue buildup is going to happen. Now this is from a study point of view only we have done what actually happened in Microsoft. We are just trying to replicate that exact model into Excel. Now the ultimate objective of all these sheets, the revenue buildup, the cost buildup, the asset schedule, equity, DuPont analysis. DuPont analysis is like return on capital employed, the ROCE tree, to find out what are the returns and how where am I missing the goals, etc. And I go ultimately to the valuation as to the value that I am going to earn from this equity shares. Okay, so this is a simple model that we do for equity valuation, or I mean, generally for valuation forecasting technique, NPV, price to book value. There is another term that is price to earning ratio. Price to earning ratio, I think one of the very vital ratios. Let me just conclude by just these two more points: EPS and one was the beta, where we looked at CAPM model. EPS is one of the fundamental things when we have to identify which are the financial instruments. Now, let me not use the word stocks here. Which are the financial instruments which are undervalued and overvalued? We have to look at the industry per se. For example, if I'm in auto market, what is the EPS for auto sector? Let us again, EPS for auto sector could be, I mean, on investing.com you can find that EPS would be say 100 is the EPS. And now I'm looking at a company, say Tata Motors, and the EPS of Tata Motors is say 120, for example. That means Tata Motors is significant at a significant premium over the market. Okay, so it is either overvalued, okay, or the market might move from 100 rupees to 120 rupees EPS. Okay, so that price to earning ratio, sorry, PE ratio I'm talking about, price to earning ratio. So the market will move from 100 PE to maybe 120 PE, or Tata Motors will come down from 120 PE and it will align itself along with the industry PE. Because this company, I think, given the cutthroat competition that is happening in the market right now, that price to earning ratio plays a very vital role in identifying two things: overvalued stocks and undervalued stocks, and what is the trend of the market and which are those undervalued stocks that you can. Now, after identification of those undervalued stocks, you have to start doing your fundamental analysis. What is the beta of that stock? What is the pedigree of that company? I mean, whether the management is good. What are the historical returns? What are the dividend returns? What are the cash flows? What are the capex requirements? So on and so forth. Looking at all those things, you will be able to identify which are the stocks that or instruments that you can put your money in. It could be forex also. It could be bullion also. It could be commodities also. So on and so forth. The other point was about beta. Beta is also very vital when it comes to selection of financial instruments in the market, in capital markets. When you are looking at typically, I mean, if you are a very risk prone investor, then you should look for companies which have a very high beta, or sectors which have a very high beta. For example, financial sectors has a very high beta as compared to maybe auto sector. Okay, pharma has a low beta as compared to auto sector. So depending on that beta, how, if market move by 1%, is my stock moving by 1% or 1.5%, 1.5 times or 1.5 times or 1.8 times or 0.5 times or whatever. So if it is 1:1 ratio, if market moves by 1 time and my beta also is by 1 times, companies like, for example, Hindustan Unilever, ITC, Bajaj Finance, these are like what do you call, low beta stocks. That means even if the market moves significantly, the significant downside in these stocks is also capped as per the market. So identify which are those low beta companies and which are those high beta. High beta companies generally we should stay away. High beta stocks, high beta instruments, high beta even cryptocurrencies and stuff like that. We should stay away from those high beta stuff, and we should focus on more the low hanging fruits that we should capture. But again, with a caveat, we have to identify whether that low hanging fruit is really good enough for us to take into to the next level. So that is price earning and EPS. So these are some key technical patterns: double top, double bottom, triangles. There are several. I mean, YouTube is flooded with all these tools. But again, I always suggest that you should always take all those advices with a pinch of salt, because there is no one technical analysis or one fundamental parameter that will decide what will happen to the stock. You are understanding the overall analysis of the stock market, overall analysis of the sector, overall analysis of the company, overall analysis of the peers. All these things will play a very vital role, and then this would be supplementary to your investing personality. These are not the thumb rule or head and shoulder dig gaya mere ko I will make good money or whatever. Or if I see a flag, I will. I mean, a head and shoulder also is like a flag only. But again, cup handle. Let me just give you one very last, if just low hanging fruits. I mean, a cup and handle scenario, which would be maybe of good use right now since the market is. So this, if you see, let us go to a company called, say, GMR, for example, GMR Airports. Delete. GMR Airports. Let's go to this monthly. Can you see a very nice cup? If you see, this is a terrific cup that has happened in this company. I mean, if you are able to identify this kind of companies, you are in a terrific spot. Now, this company, GMR Airports, I mean, it was languishing at 8 rupees, 9 rupees, 10 rupees, and suddenly there was a lot of news that started coming in. Okay. If you see, there is this cup that got formed over here to here, maybe. Okay. A typical cup that got formed over here. And then there was also a handle that got formed. Okay. If you see, there is this cup and handle that has got formed. If I am able to, sorry. So if you see, the moment it has breached the handle, okay, from 49 to 100 rupees in what? 6 to 7 months. So this is how cup and handle, and generally cup and handle, I mean, all these parameters or all this. Are you able to see the screen, right? Okay. So that's about it on this. Oh, we are not able to see the calculation. Okay, so this is any questions now? I think we are already past 7. I can go on for another 3-4 hours if you guys are interested. I mean, I have no problems with that. But I mean, any questions on this? I mean, I hope we did it in very quick time. Generally, this kind of things, we do it almost for a full day sessions and stuff like that. But valuation in itself is a very, very massive topic, which has a lot of ifs and buts, and it has got a lot of layers that are embedded into that. A typical valuation exercise that we do, I mean, in a merger and acquisition, goes on all the way from 1 month to maybe 3-4 months. There are a lot of iterations that happen in the market. The assumptions keep changing. There are several things. There are a lot of moving things in when we do a forecasting exercise. But it is exercise. I mean, say so it's you have to plan for the best, so that iterations happen for anticipating where will I be after a year or so. Okay, so I need to find out. I mean, the most important aspect of capital market, if I have to sum it in just one sentence, everybody are trying to anticipate what will happen tomorrow. That is it. Okay, so we don't care about any fundamental technical whatever analysis, but those analysis will be able to help us to find out what will happen to this stock market tomorrow or what will happen to this capital market tomorrow. So anticipation is what everybody are trying to achieve or aim for. Tata Motors today is at 650, tomorrow it will be at 700, 800, jo bhi hai. So my investment paradigm or dimension is to find out what will happen tomorrow. So I'll rest my case over here. I mean, if there are any questions, I will be more than happy to answer.
Yes, participants, you can raise the questions if you are having any doubt.
I hope, I mean, is this what you were expecting, or was it something different? I'm not sure actually, because I got it
Yes,
very
sir,
late actually.
this is what we expect actually. But
Okay.
we have already recorded, so no issues.
Oh, okay, good.
Mm. Yes, participants,
Faculty members,
if all
please
our
ask
faculty.
questions. I mean, nowadays, I mean, since I also visit in several colleges, I mean, students are also very hesitant in asking questions.
Yes.
So faculties today are students. So
Good evening, sir.
Yes,
Yes,
Good
sir.
sir,
evening,
that's
sir.
the question.
Yes.
Good evening.
Yeah, I just have one doubt. I just want to know about this institutional investors, which are there. So if I'm looking out for a data on the FII flows, which is available on NSDL and all, but I want each company wise, daily trading in the particular company. So does that data is available?
Oh yeah, 100%. That data is certainly available. I mean, if you go to National Stock Exchange website, you have got
Mm.
data by hour, by in fact by 15 minutes or so. Just have to
Yeah,
download
yeah,
that
but
data
yeah,
for every
that is
company. For say Tata Motors, you are saying, right?
no. I'm asking about FII and DIS.
Yeah. So
The
FII data is also available on National Stock Exchange website. The National Stock NSE website is a gold mine of information. Even BSE website for that matter, they are gold mine of
no,
information. Hmm.
I checked the data. I checked the data, but what I'm looking out for is in a particular company, let's say Tata Motors, every day how many FIIs are investing that way. That type of data.
Well, I
Company
mean,
wise,
you will have to do a little bit of slicing and dicing of that data. You will get
hmm.
all the data, but generally on the stock market, I mean NSE and BSE will not identify. You will get the data for Tata Motors, but in Tata Motors, which FI and which DI is investing, that will not be available, because that is
So that's what I'm looking out for. That's what I'm
uh,
looking out for.
you will get that data. There are some data more what do you call databases
Yeah,
that
yeah.
are available, but
Yeah,
again
but
those are not
this
very
data is
reliable.
not available. So just wanted to confirm from you since you have a good wide
Correct.
knowledge in this area. Yeah.
Yeah, that data is not.
Yeah.
I mean, again, I'll check again. That data also would be available. That would be historical data, may not be day in day out.
Yeah,
But again,
I know the quarterly holdings. You get the quarterly holdings. That
correct.
is available. But how many number of volume is not available. That case
Total volume is
for the
available
particular company.
by particular segment. It's not available. You're right.
Yeah, that's what I just wanted to know. Yeah.
Yeah. But it's food for
Thank you.
thought for me. I'll check. I'll certainly take a look at it. I mean, if that data is available, I'll just pass it on to you. The
Okay.
source.
Thank you, sir. Yeah.
All right.
Yeah. Thank you, sir. Yeah.
Thank you. Thank you so much.
So any other questions? Okay. Then over to Sajid. You are there?
Yes, sir. As we come to the end of this enriching session, I would like to take a moment to express my heartfelt gratitude. First and foremost, I extend my sincere gratitude to the Almighty for His blessing, which made this event a success. I extend my deepest thanks to our esteemed speaker, Prasad J. Kulkarni, for sharing his valuable insights and expertise with us. The session has been incredibly informative and has provided us with a profound understanding. I would also like to express my heartfelt gratitude to the management, Dr. Aloysius Edward, Dean Faculty of Commerce and Management, Dr. Joseph Charles, Head, School of Management, and faculty members and participants for their active participation. Thank you.
Thank you, sir.
Thank you very much, sir. It was a pleasure interacting with you guys again. I
Yes.
hope we'll have some other opportunities also to interact.
Yes, we will provide it.
Yes. Thank you so much for all the to all the participants for their patience. Thank you very much.
Yes. Participants, for you one information, tomorrow's session will start by 7 o'clock instead of 6 p.m. because some of the participants text that you will reach home only by 6:30. So tomorrow's session will start by 7. Okay, sir. Thank you, sir.
Thank you so much. Thank you so much.
Thank you.
Bye. Ciao.